Hello everyone, the market has a meltdown last week after CPI turned out to be worse than expected. So where do we go from here? Are we expecting another low or crash in the stock market? In this video, I will share my thoughts on the latest plunge and my investment plan ahead. I will also touch on the stocks that I have bought last week, as well as some of the target prices for certain stocks in the upcoming weeks. Hence, stay tuned to find out more. So last week, the stock market plummeted after a hotter than expected August consumer price index data was announced. And this ugly and massive sell-off on last Tuesday registered the worst day in the stock market since June 2020. To highlight, the CPI report is one of the last that the Fed will assess ahead of their meeting on 20th and 21st September. Not sure if you guys recall, the Fed previously mentioned that the next rate hike will be very much dependent on the various economic reports. With inflation still red hot, many investors quickly switched to risk-averse mode as the unexpectedly August high CPI number could lead the Fed to increase the interest rate higher than what some investors are anticipating, which is 75 basis points right now. To make sentiment even worse, big corporations are releasing negative news. For instance, FedEx CEO said that he expects the economy to enter a worldwide recession. The company is also planning to close offices, freeze hiring, and ground aircraft in response to a declined volumes of packages moving around the world. To add on, Goldman Sachs is also preparing to cut hundreds of jobs, and General Electric warned that supply chain issues still persist and will impact their revenue and profits. Interestingly, during the closing hours of last Friday's session, there were sharp bounces across various mega-cap stocks. So it will be interesting to see how the market moves on Monday and leading to FOMC meeting on Tuesday and Wednesday. Anyway, my wild guess for the sharp rallies is that it is likely due to quad reaching day where institutions covered their short positions. Just a wild guess, not financial advice, alright? Okay, as we enter the week where FOMC meeting is going to take place, many investors will be thinking or even speculating on whether will the Fed raise the interest rate by 100 basis points. Such aggressive interest rate hike could potentially send the economy into recession. To be very honest, my view is that the Fed hands are really tight. The current situation shows that whatever they have been doing are not helping to bring the inflation down. And it appears that recession could be the way to curb this sticky inflation. To quote Jerome Powell, this inflation fight could bring pain and job losses. Anyway, at this junction, I would think it is crystal clear that Fed is not going to pivot, which some investors haven't seen till this date. And this is something that I have been sharing when we had that massive rally that stretched from June to August. Okay, here's another thing that I want to highlight. It appears that the market is full of pessimism now with various negative news. So I would think everyone kind of expects the market to continue its meltdown next week. But who knows, the market may just do the opposite and bounce up. I wouldn't think this is entirely impossible as the stock market has been very oversold since last Tuesday and a relief rally could happen. But don't get me wrong, I'm not saying that we are ready to reverse. In the near term, I think the market is still very bearish, which I have shared in my last videos and thoughts. But because the market has sold off so massively last week, I thought it's good to caution investors who are late to the bear party and bought puts at the later half of the week. The point here is do not have a bias that the market will dump even more next week. I mean, given the weak market sentiment, it could happen, yes, but just don't get caught off guard if there is a rally. And this brings me to the technical segment. Watch out for various key resistance and support levels. Do your homework and take action when necessary if the odds are against you. Quick disclaimer again, whatever shared here are not financial advices, okay? And before I move on to the technical analysis segment, can I have your help to hit the like and subscribe buttons if you have found a small bit of value in my video? Your little action will keep me going. Thank you. Okay, let's take a look at the technical aspect of the stock market. Starting things off with SPY, which represents the broader market. In view of the huge meltdown, this week I decided to take a step back to look at things via a longer time frame, using the weekly chart. The weekly chart is painting a bearish picture as a bearish engulfing candle was formed last week. Then, check out the green support trend line that I have drawn, which stretches all the way to September 2020. If the market wants to fall in the upcoming 1 to 2 weeks, we could test this support line. and this means we could fall below 380. From that point, watch how the market moves. Specifically, see if the market can rebound from here. If it doesn't, then we could test the low of 2022 at around 360. Now let's take a look at the Fibonacci retracement level. If bulls still don't step in at 360, the next Fibonacci support level is actually at 333. But here's the good news. On its way down, the 200 moving average should offer a super strong support at 347. And this is where I am of the view that the market should rebound. Because if you were to zoom out the chart, the last time round SPY tested this 200 moving average on the weekly chart was during COVID's crash. And before this, you will have to go all the way back to about 11 years ago during August and September 2011, where this 200 moving average was briefly breached. And since we are on this, it is also worth highlighting that during the global financial crisis in 2008, SPY went below the 200 moving average for about 2 years. At this point, I think the probability of this repeating is relatively low unless proven otherwise. Looking at the daily chart, there are two gaps waiting to be filled. One is between 377 and 378, and the other is between 367 to 368. Both gaps coincide with the info that I have just shared based on the weekly chart. But if let's say Fed is dovish next week, or if they announce 75 basis points rate hike and the market has so-called priced in this amount and it decides to rally, keep a lookout for this red downward trend line that I have drawn. We need to break above this to turn the very bearish sentiment to slightly less bearish. And if the rally continues, I'm expecting it to fill the big gap between 401 to 406. At this point, I believe sellers may start stepping in, but I have no crystal ball, so watch how the market moves and you ride with the trend. And something to highlight, there is a hidden bullish divergence spotted on RSI, so we could have a little rally next week, but big caveat, Feb is the wildcard and they can invalidate the various indicators. Who knows, maybe the market rallies on Monday and Tuesday before Feb's announcement on rate hike. Anything is possible. Moving on to Apple, similar to SPY, there is also a bullish RSI divergence on Apple stock. So perhaps a potential rally coming up early next week. But this aside, it appears that the stock wants to test the crucial 61.8 Fibonacci retracement level at 146. And if this gets breached, I really don't see a lot of support or liquidity all the way to around 140. Apple is currently sitting at 150, and mind you, a 10-point drop for Apple is actually quite significant. And to be honest, I do hope it can go below 145 at least, so that I can pick up some shares. Since there is a bullish divergence, so let's talk about what to look out for if there is a relief rally. On the upside, a small and immediate hurdle is 152. The major resistance is between 158 to 160 because there is where the 38.2 Fibonacci level, 50 moving average and 200 moving average are. So if Apple can break above all these three levels, it will be quite bullish and call options should be printing money. But my view is we may get rejected at this area. Next, we have Tesla. Looking bullish at the moment, but before we get too excited, just a gentle reminder again that Tesla is very volatile. I mean, we can sit comfortably above 300 now, but I wouldn't be surprised if we start hitting 280s the next moment. Previously, I mentioned that Tesla recently has been going above the 200 moving average and then got rejected. It happened 3 times in the last 1 month, and so now we are above 200 moving average again. If I am a call option holder, I will take profits now because the probability of it going below again is higher than it staying above. Again, this is not a financial advice. Anyway, on the downside, keep a lookout for 293 and the gap between 289 to 290. On the upside, I will have to zoom out the chart. Can you see the red downward trend line which I have drawn since a few videos ago? So if Fed gives us some good news and the market wants to fly, we can go as high as 340s before hitting the next resistance. But I'm a little reserved here and I wouldn't chase this bull run if it were to happen. Next, Microsoft. There is also a bullish RSI divergence spotted. With these various bullish divergences, so maybe, just my wild guess, the market makers may bring the market up a little in early this week, aka a relief rally, to cool the indicators as they wait for Fed's announcement on the rate hike. Anyway, I step in to buy Microsoft again at 243. As shared previously, Microsoft has been consolidating between 240 to 270 since May this year. So personally, I thought it's not a bad entry point when it hit the lower end of the consolidation zone. That said, as I zoom out the chart, can you see the blue lines that I have drawn previously? I think these were drawn at least 3 months ago. That is another huge consolidation zone between 200 to 220s. It may seem crazy when Microsoft was at 290s, but it doesn't seem so when it is at 240s now. So if Microsoft ever goes into this zone, I will be more excited and aggressive in my buying. On the upside, if the market and Microsoft want to fly, we can expect it to fill the gap at 260 to 265 and then to face some resistance at 270. Alright, moving on to Google. This is the other company that I stepped in to buy. It was showing extreme weakness as it briefly tested 100 and created a new 52-week low. It also finally invalidated the zigzag pattern that it has been making since April this year. Anyway, I step in at 104 and 105. At this point, I am seeing 100 as a strong support level and it should hold. But you never know, if say Fed throws in the curveball and the market has a bloodbath, Google could finally break below 100 again. When that happens, expect the gap between 97 to 99 to be filled. Day by day, it seems like this is likely the case. I don't know, I can't really predict, but what I know is that Google below 100 is a great buying opportunity for me. To also share, I have sold put contracts with 90 and 100 strike prices, and these are key support levels. If they hold, great, I earn the premiums. If they don't, I am happy to hold 100 shares of Google at these prices per contract. Okay, some end thoughts to wrap the video up. I think investors who had hoped that the rally from June to August was the beginning of a new bull market got a wake-up call when CPI on Tuesday confirmed that inflation remains stubbornly high and that macro factors can outweigh companies' fundamentals. But does this mean we should temporarily stay away from the market till the macro environment has improved and the stock market is recovering? Well, you could do that, but that's not my plan. My plan is to pick up stocks when macro environment is weak and the market is going down. The reason is actually very simple. The environment will improve and good stocks will go up again eventually. It's just a matter of time. And the issue is, I cannot time it accurately, so I would rather dip my toes into the market slowly and carefully and stay invested despite the tough times. In my view, the gist of long-term investing is about putting your money into the stock market periodically. Note periodically does not mean systematically, meaning to say with the bearish market, you can pause your say weekly or monthly DCA plan. Instead, what one can consider doing is to put the money into the stock market whenever there are signs of significant pullbacks, which is my current approach. In fact, I am quite busy queuing and picking up shares lately, like a small boy eager to enter a toy store to pick some toys on discount. But of course, the caveat is that's my game plan and may differ from yours. I mean, for investors who do not want to commit time to watching the charts or stock movements, you can still do your monthly DCA or quarterly DCA or whichever time frame you prefer. Or you may just consider buying the indices such as the S&P 500. The key message here is start accumulating shares when the market is weak, else you may be left missing out on the gains later or left to chase the bulls when the market reverses. Alright, that's all for this video. If you have learned something from this video, please help to hit the like and subscribe buttons. They mean a lot to me and will keep me going. Thank you.